everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. Today we're going to highlight the major economic news from the week of September 8th through the 12th. The latest data presents a bit of a puzzle, with some key indicators showing improvement while others point to a slowdown. These conflicting signals have created an interesting situation for investors and policymakers alike, especially as we head into a major Federal Reserve meeting. First, let's talk about inflation. The latest reports give us a split picture. On one hand, we have the Consumer Price Index. As you can see in this chart, consumer inflation picked up in August, rising to its highest level in 7 months, meaning that prices for everyday goods and services are still rising for consumers. However, the Producer Price Index, which measures wholesale prices, tells a different story. This index actually fell in August, which was a surprise to many. The PPI is often considered a leading indicator because a drop in costs for businesses can eventually lead to lower prices for consumers. Despite this promising sign, the fact that consumer prices have accelerated for 4 consecutive months highlights how stubborn inflation has become. Next, let's shift to the other side of the Fed's dual mandate, the labor market. The most recent data suggests some clear weakening. Initial unemployment claims experienced its largest weekly increase in almost a year, jumping to its highest level in 4 years, a clear sign that layoffs are picking up. Meanwhile, continuing unemployment claims continue to hover near multi-year highs like they have been for the past few months. Now, when you combine the rising initial claims with the persistently high continuing claims, it suggests that not only are more people losing their jobs, but they are also having a harder time finding new ones, pointing to a softening labor market. And the uncertainty in the economy is also affecting how people feel. The University of Michigan's Consumer Sentiment Index fell for a second straight month in September, reaching its lowest point since May. The University of Michigan's Consumer Sentiment Index fell for a second straight month in September, reaching its lowest level since May. This decline reflects ongoing concerns among consumers about business conditions, the labor market, and inflation. Less confident consumers often lead to less spending, which could further slow the economy. So how did the market react to all this? The signs of a cooling labor market, along with the mixed inflation data, have increased the likelihood of a Fed rate cut. The CME FedWatch tool shows a 100% probability for a rate cut at the upcoming meeting, with a very, very high likelihood that it will just be 25 basis points. The market is also pricing in 2 additional 25 basis point cuts at the October and December meeting and 3 further cuts in 2026. And lower interest rates are generally seen as positive for stocks. That's why the S&P 500 responded positively last week, notching a 4-day win streak and reaching several new record highs throughout the week, which ultimately led to the index's 5th weekly gain in the past 6 weeks. And in the bond market, Treasury yields continued to fall as market participants reacted to the economic data and the increased probability of a Fed rate cut. The 10-year note finished the week at 4.06%, one of its lowest levels in 5 months, and the 2-year note at 3.56%, one of its lowest levels in almost a year. Lowering rates to support a softening labor market, but being careful not to overdo it and reignite inflation, which is still sitting well above its 2% target. Last week's economic data further cements the notion that the path ahead is anything but simple. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.